We are doing question number 52 to 56. We have all of these questions, and here is the fact that is relevant for all these questions. During the year ended 31st December 18, L company built an extension to its head office. The cost associated with the head office extension are as follows. So, land acquisition 10 million, fees for environmental certifications and building permits half million, architect and engineer fees 1 million, construction material and labor cost 6.6 million. At 30th September 2018, the date when the head office extension became available for use. So on this date, 30th September 18, it became available for use. The cost of unused materials on site amounted to 2.5 million. At that date, the total borrowing cost incurred on a loan which was used specifically to finance the head office extension amounted to uh, zero point 0.8 million, which is like borrowing cost. Then they are saying L company also acquired 100% of a subsidiary. So we will come back to this, but looks like this fact that we just discussed, this is relevant for question number 52, where they are asking for the year end 31st December 18, how much should be capitalized in respect of the construction of the extension to the head office building? How much will be capitalized? So what we can do? So land acquisition, we will take for capitalization. Fees for environmental certification and building permits, definitely will take this also. Architect and engineer fees also. Construction materials and surplus, this all. And this borrowing cost, and this is cost of unused material. So this we will deduct. This is left, and we will add borrowing cost. Okay. So all are positive adjustments. Only this cost of unused materials. This will be your negative adjustment, and everything else we will take. This all will be added. Okay. So if you add this, all of it, and just deduct this cost of unused material, so 18.4 will be what? It will be the amount to capitalize in respect of construction. So first will be the answer for this. Okay, which is 18.4 million. 53. L company incurred further expenditure on the head extension after it had been completed. Which of the following would qualify as capital expenditure? Okay. Property insurance is not an capital expenditure. Okay. Capital expenditure. Property insurance, no, it is not. Installation of new office fixtures and fittings, yes. Marketing cost, no. Marketing cost, definitely no. It is not a capital expenditure. Maintenance, and relocation, expenses. These are not okay. So only this furniture and fixtures will be your answer. Installation of new office fixture and fixtures um, will qualify as capital expenditure. 54. At 31st December 19, the directors of L company decide to adopt the revaluation model of IAS 16 property. Okay. Plant and equipment of L company's property. So they're going to use revaluation in accordance with IAS 16. So they're adopting it on 31st December 19. All of these facts we discussed was on 31st December 18. So that they have this much, and then from the next year end they're adopting this revaluation model, and which statement is not correct, they're asking. In subsequent years the depreciation will be based on the revalued amounts. That's right. I mean, depreciation will be based on revalued amount, of course. I mean, what is the revalued amount, on that will calculate the depreciation. Any revaluation gain on the head office building revaluation gain on head office building is recognized in OCI. Okay, that's right. And any revaluation loss, because of this conservatism principle, any gains of this sort, revaluation gain will go to OCI. However, if there is any revaluation loss based on conservatism principle of accounting, it will go to your profit and loss. So this is also right. The original head office building and the new extension are revalued separately. No, I mean building plus if there is any extension to any fixed assets, both of it is taken together and it is combined, not separately. It will not be valued separately, it will be valued combined. So third is the wrong answer. Third will take. The residual value and the useful life of the head office building must be reviewed each year. Yeah, I mean every year this thing we do, like the useful life and residual value is reviewed each year, which is also true. This is also true. This is also true. This one is so it will be combined, but in the third statement they are saying that head office building and the new extension will be revalued separately, which is not right. So third will be our answer here. Assuming S company represents a cash generating unit, what is the carrying amount of the brand? So they are, what are they asking? They are asking carrying amount of the brand. All right. So let's see what are the facts here. So here they are saying L company also acquired 100% of a. So they acquired 100% of a subsidiary. Okay. They acquired 100% of a subsidiary. S company on L company also acquired 100% of a subsidiary. S company on 1st January 18. Okay. So on 1st January 18 they acquired. All right. The carrying amount of the assets of S company in the consolidated financial statements immediately before. Hmm. Okay. Immediately before an impairment review as follows. Okay, man. So before impairment, they are giving this. Before impairment on 31st December 18, they are giving this thing that goodwill was 1.4 million. The amounts are in million. Okay. Goodwill is 1.4. Okay, we need to increase the decimal places here. Brand name. Brand name is valued at 2. Property, plant, and equipment 6. And current assets. So there is no revaluation on this, but we'll just note it. So sum is 12. Hmm, all right, 11.8. The recoverable amount of is estimated at 9.6. Okay. Recoverable amount is how much? It is 9.6. Okay. And the impairment of the investment in S company was deemed to be 2.2 million. Impairment of the investment in S company was deemed to be 2.2 million. How is this 2.2 coming? This makes sense. But now the impairment. So we can say that total impairment is this much, right? So this is the answer for the paste it here so that we can focus here. So they acquired 100% of subsidiary right before the impairment. The goodwill was this much, brand name PP, current assets total this much, now recoverable amount this, total impairment is 2.2. So current assets, there will be no impairment on current assets. Okay. Now you have goodwill. So first, what we will do, we will write off this goodwill. Whenever there is an impairment, it will first be allocated to goodwill. So this will be this minus this goodwill will be 0. Now what is left? So 2.2 is total. So allocated to goodwill. Allocated to goodwill. How much of the impairment can be allocated to goodwill? 100% of the goodwill value. So how much is left then? Remaining impairment is how much? 2.2 minus 1 0 0.8. So this 0 0.8 will be allocated to brand name and PP in the ratio of 2 is to 6. Right? It's 2 and 6. So in this ratio, we will take this remaining impairment multiplied by 2 and divide by 8. 8 is the sum of this 2, 6 and 2. Here also we will take this 0.8 multiplied by 6 divide by 8. 8 is the sum of 6 and 2. Right? So this 0 0.8 we have allocated 1.4 to goodwill, current assets to 0, and then our sub 2.2, which they said that total impairment is 2.2. Then after all of it, you will have how much of this 9.6, which is also true. We did all the maths. So out of this 2.2, 0.2 is brand name. And what is the question they are asking? Uh, Assuming its company represents a cash generating unit, what is the carrying amount of the brand? They're asking about the carrying amount of the brand. So carrying amount of the brand is how much? It is 1.8. Okay. 2 was the earlier value, then after 0.2 of impairment is 1.8. So our answer should be 1.8. Fourth will be the answer here. Okay. Which is 1.8 million. 56. Which, if any, of the following statements regarding impairment review is or are correct? Okay, which is correct? At the regarding impairment review, they are saying. So, are these all about impairment? Uh, no, this is about capitalization and all. It's a mix of two things. Okay. Anyways, so which, if any, of the following statements regarding impairment reviews is are correct? At the end of each reporting period, an entity should assess if there is any indication that assets have been impaired. Yeah, yeah. I mean, after each reporting period, an entity should assess if there is any indication that assets have been impaired, right? Annual impairment reviews are required on all intangible assets with indefinite lives. Yeah, they have indefinite lives. Annual impairment reviews are required on all intangible assets with indefinite life. So both of these statements are true. Okay. All right.